Chapter 4 was introducing the basic concept of the cost model. I'm going to show you the two changes and things that we want to think about in Chapter 5. It's fine to look at it, but do not do the following, don't watch the following video until you've actually practiced the Chapter 4 journal entries and other problems quite a lot. Okay? You can watch the rest of this video, that's fine. It shows some of the way the direction we're going, but don't look at the next one until you actually know those journal entries fairly well. So, here we have the Chapter 5 direction that we're headed. Notice this is not the same as the one I had on one of the prior videos. It shows the changes that we're seeing in Chapter 5. So Chapter 5 now is pretty realistic. It's still a school example, so it's small, but we've now abandoned that thing called product cost. Okay, in Chapter 5 it's gone because it was only a teaching device that we used in Chapter 4. In Chapter 5 we're doing two things in depth. We already did a little bit of this in Chapter 4. One of the pieces we already did was that idea of over-applied and under-applied overhead. You got to work a couple of Chapter 4 problems because when you get here, it's like getting more complicated. The main thing we did in a sense of simple journal entries is we added this concept of a job. Okay? Notice almost all of this stuff is the same. I haven't drawn all the lines because it gets a little messy. But what happens here is we now have WIP, and we also have WIP Job 1. So we have introduced the idea of a control account and subsidiary ledger system. One thing we won't make you do is do the posting. In a traditional accounting system like a paper-based or even the early computer-based systems that were done based on a hierarchical database, which is, trust me, you don't want to know about it. They used to do this, and it was double posted. So a journal entry that went from, say, raw material inventory, you have to post that, copy it into the control account and also into the subsidiary account. Because the only way to keep the balances correct is if the dollar totals appear in both the control account and the subsidiary account. And when you do that right, the control account gives you the overall total, and then you look in here for the total associated with one job or one client or one audit, whatever, or actually this could be a restaurant meal. So restaurant software, you're looking at the model of restaurant software right now. One ticket that the server works on is one job, okay? Notice it has its own number. Everything associated with that ticket is together, so it's a job. So this is really common in software. This is one of the expansions that we now will no longer say, product cost doesn't appear in a journal entry. We're going to say WIP Job 1, WIP Job 2. As soon as you see WIP Job 1 in a journal entry, you know, oh, double post. Post it to the job and then also post it here. Like I said, we're not going to do it. We're simplifying that a little bit, so we will just say WIP Job 1, and we will assume that you know what you're doing, which you probably won't, but that's a little bit of a skill we can abandon, that double posting. But what we will ask you to do is, I will say, in the exam and other questions will say, what's the total in WIP at any point in time? You have to know that you have to add up all the jobs to get the total in WIP. In effect, by adding them up, you're deriving what we would have gotten through the double posting. The other thing is we're adding another account here to finished goods inventory called FGI spoilage or FGI salvage. Sometimes it's called, I think we're going to call it spoilage, but you could call it salvage. Notice that there are no lines going to this because this is not used periodically is the wrong word. It's not used repetitively. These journal entries, the reason we're teaching them to you as a system and that they're numbered is every one of these happens the exact same way, and in big companies happens like 300 times a day. Just the journal entry form is always the same. The numbers could be different, but the form of the journal entry is just completely automated. This is not true. This is part of the factory, and it's an important part of dealing with overhead, but they're all unique entries. So we're now adding this. And so you need to visualize that as part of the system, but there's no lines because it happens, only unique events will trigger the actual use of this account. This is where we're going to have the problem. It's going to associate it with FGI spoilage. FGI spoilage is a subsidiary account of FGI. So FGI is now a control account also, and it has a subsidiary account. Coming back to here, All of these entries out of 7 are only based on the POR. And I can see I shouldn't be holding this pen open so long. I should put the cap on while I'm talking so that I can actually make the ink last a little bit longer. This is one of the big drags about not being at Brock is all of the whiteboard markers are at Brock. This is based only on the POR. Okay? So hold that thought. I'm going to show you an example here that your brain's going to like go kaboof, explode. Then what we'll do is in the next recording, we'll actually do the journal entries to help you try and get it a little deeper in your brain. Right now, we're going to do the abstract version of what we're doing. So all of these journal entries are based on actual transactions, right? That's important. You know, it seems obvious perhaps for this purpose as we're starting to make an important distinction. Everything, all these credits are based on actual transactions. You know, we're paying somebody, we're buying something. So all of the debits here on this side, based on actual transactions. Right? All of these credits transferring from raw materials into work in process based on actual moves of real pieces of raw material. This transfer from gross wages into the jobs is based on our knowledge and record-keeping system of actual hours that people worked on these jobs. If you were on a co-op work term and you were working on different clients, then when you did some of your documentation, you know you recorded the number of hours you worked on a different job. That was this. But this is totally different. None of these journal entries, and notice I made the arrow short because it would get really messy up here, but there are 3 arrows here because you would post to the main account and then also post to the job. None of those is based on any actual. It's all based on the estimate, and the estimate is the predetermined overhead rate. So now I'm going to walk you through how we actually do this, which will all sync up to you. So basically, you're going to have to you're now in forecast land. The next little bit, we're not talking about anything from inside the accounting system at all. We're budgeting, so we're doing this. Everything I'm going to do now is for next period. Okay? It's not for anything we're doing now. We're coming up with our estimates for the next period. So we talk to the sales guys and we say, how many units do you think you can sell next period? So then they're going to tell us 1,000 units, whatever they tell us. Okay? And we're not going to believe them because they're sales guys. And we're going to go back and we're saying, all right, we're going to say, are you really serious? And we'll push them around a little bit. And then whatever number they finally come up with, we'll put here. So we'll say, okay, we'll sell 1,000 units. Well, we need to actually make those 1,000 units. And so what overhead line items are we going to use to make those 1,000 units? Well, you're going to start making a list, and then you'll figure this out. So let's just start with this, taxes. You have property taxes, right? You're going to have to pay. We have to pay those every year, so you need to put those in the budget. You're going to have electricity, water. This is always something that screws up people coming to Canada, because as far as I know, Canada is the only place in the world where we call electricity hydro. And the reason's obvious. When we started to get a lot of electricity in Canada, it was almost all from hydroelectric plants, and the companies were called like Toronto Hydroelectric. But for short, to come up with a slang, people just called it Toronto Hydro. So it's hydro. So when someone comes to Canada, like when I came to Canada, and I'm starting to do some of this work, I'm going, wait a minute. Instead of writing electricity, they would write hydro, and I'd see hydro here, and then I would see water, and I'd say, wait a minute, isn't hydro? Doesn't that mean water? Anyway, it's if you're all your experiences in Canada, you might not know that. But if you have some international experience, you'll know that this confuses the devil out of people. Not for very long, they get it immediately. But it does confuse people when they see that most Canadians call it hydro, when internationally it would only be known as electricity. And let's see, we have water. Let me look at my list here. Custodial and spoilage. So custodial, spoilage. So you're going to go out and budget all these things. And is it just going to be a list here? Is it going to be 5 items? No. When you're doing this, this is, you're You'll be doing this like in your first couple of years after Brock. If you're working in a large organization and working in their internal systems, this would be something you would get in your first couple of years. And this will take you like a month. It'll take you a month of beating your head against the wall to try and figure out the estimate of all these things for next year. And it's not going to be 5. What you're going to have to do is identify every category of overhead that you actually use, and you're going to have to forecast every single one of them. And mostly you're not going to use statistics because that just screws things up. That's not a good idea. So I have a numeric example worked out here so that I can show this fairly easy. So I'm going to say that you came up with $100 in tax, $200 here, $50 in your water bill. Your custodial was $300 and $50 for spoilage. Okay, so we add that up, 5, 6, 7. Another little side lesson here. All numbers in accounting have to be identified unambiguously. We have a very strong practice in accounting that if you have a column of numbers, and notice we're accountants, we always have columns of numbers. If you identify the first one in the column, we assume that every number below it has the same unit identification until we get to the end of the column. Anytime you have a line, we assume that the column's done. So that's the meaning. That's why you have that pattern of dollar signs. Any bar means end of column. So below that, it may not be dollars. Now, you haven't seen that a lot yet, but that's another thing in this class, especially, like I said, chapter 7, 8. We're going to see a lot of numbers on here that are not dollars. Anytime you break a column, you have to verify that the number below it is of the same unit type. In this case, that means you need a dollar sign. And the double underscore means it's the end of the concept. It's the end of the thing you're computing. There's nothing else left here. Okay? That's a little bit of a side thing. So you have this giant thing, you went out. Some of them are actually pretty easy. Figuring out next year's property taxes is pretty easy because almost all governments let you know like 18 months in advance. You know, this one's actually one of the easy ones. Everything else could be quite a trick, and there are errors everywhere. So error, except for the tax, every one of these has a bunch of errors in it because you don't really know, and you really can't use regression. Some people do, but I try and caution them not to, especially in the modern environment, because if you want to use regression analysis, you got to use like 5, 6, 7 years data. And then I always say to them, is this factory still set up the same way it was 5 years ago? And if the answer is not yes, then you can't use that data, right? I know a lot of beginners ignore that because because Excel will do the computations. You can only do a regression if the context hasn't changed. So that means for the most part, you can't even really use a regression here. So this is a pile of work. This class is not a class on budgeting this, and it's not a forecasting class, so we're not going to do this. We basically, every time you need this, we'll give it to you. Sometimes we'll give it to you in a sneaky way, but you don't ultimately have to do the forecast. You just have to recognize we provide you the data to do it. So then all of a sudden you have total overhead. You're also seeing a bunch of initials. This book uses a lot of initials because we have a huge number of technical terms in the book, and if we type them all out every time we use them, the entire page would just be, half of it would be these technical terms. Total overhead, okay? And what we're actually doing is a TOH-POR, total overhead predetermined overhead rate. Okay, that's technically what we're doing. I'm just going to call it a POR right now because we're just starting to use it, but that is a TOH-POR. It's not a VOH-POR or an FOH-POR, meaning fixed overhead predetermined overhead rate or variable overhead predetermined overhead rate. So there are different PORs that you can have. So right now you're looking at this and you go, oh, here's my forecast. This is all the overhead that I have. Oh, and this is the number of units. So I can do a POR. My POR is going to be $700 divided by 1,000 units, or $0.7 per unit. Now this number is going to be what's in every journal entry, $0.7 per unit. And it doesn't have to be units. It could be direct labor hours, whatever you ask them to do. you could ask them how many labor hours you're going to use next year, how many things you're going to make. The denominator is not important for this problem, okay? There are many different denominators possible out there. And so we're looking at this. Now, here's the crunch piece. This is the theory thing where we're going to see the problem. Is at the end of the year, we need this to be 0. Because if we've done a good job of estimating our manufacturing overhead, then our estimates will equal our actuals. Now, it never works that way because we got layers of bad estimates here. So actually, everything in here is wrong. One, it's not going to be 1,000 units. None of these are going to be correct, although the taxes actually might, because like I said, in most cases, you're told exactly what it's going to be a long time ahead. Everything else here is going to be wrong. Everything on your entire list is going to be wrong. So you can have wrong numbers here, wrong denominator, so this is wrong, and so this is wrong, so that means everything that goes into here is wrong. If you're really skillful and work hard, though, it'll be wrong, but it'll be close. It'll be like, you know, plus or minus 10%, plus or minus 5%. You can live with that, okay? We can do that. Now, what's going to happen here is if we were perfect, then at the end of the year, this would be 0. There would be no over or under applied overhead. The reason we have this concept of over or under applied overhead is because these forecasts are never correct. Because notice on this side, now I'm going to call your attention to this, and I've done it before, so this is repetition. This journal entry, all these debits, all these credits here are based on actual transactions, right? All of the debits here, actual transactions right here. This credit, actual transaction. This credit, actual. But look at this one. Completely based on the forecast. There's no actual information in here. So if our forecast is perfect, then at the end of the year, these two things will be equal, and it'll be a 0 balance, right? Because the amount we transferred in will be equal to the amount we transferred out. So what happens when these two are equal is the ending balance is 0. Except that's not actually the truth, because there's one piece that will not have a debit entry here, and that's this spoilage piece. Notice that everything else here, we're going to end up with a transaction with an external party, right? We're going to pay taxes to the government. We're going to pay electricity bills to, electricity company. We're going to pay water to the government. Usually, some places it's private water companies, but usually in Canada it's a public water company. We're going to pay the labor for our custodians to them. But the spoilage, where the heck does that come from? Do we have somebody that sells us spoilage? No. So this is the piece that causes a problem with our system. The underlying logic leaves a hole in our system, and we have to fix that hole. So that is a part of what we're learning in Chapter 5. And it's a mind-frying experience to get a hold of it, because it sort of violates, or it looks like it's violating a lot of stuff that we're doing. So the reason for this, and the reason for the concept of those funky journal entries for spoilage, is because this forecast item is the only one that doesn't have an actual debit that we can locate with a transaction with an external party. So somehow we have to find that transaction if we have spoilage. So I'm going to show you the transaction here for one of the cases. When we're dealing with spoilage, there are 5 different situations. And remember, in accounting, especially financial accounting, one rule doesn't apply to every circumstance in most cases, especially now that you're in a more advanced study. You have to know what the context is, and under certain contexts, a certain rule will apply in a certain way. For spoilage, there are 5 different situations. That is not for this video. I'm going to show you the type of journal entry you would have for the one situation that actually closes this loop. So if you have spoilage, let's say in job number 2, you have over here, let's say you have $500 that you've put into job number 2. That's the balance here. And boom, you have an accident and the whole thing's trash and not even resellable. Like, you can't pull it over here and then sell it for scrap to a scrap dealer. This stuff has to actually go in the trash can. Well, what you have to do is you have to get it out of job 2. How do you do that? Well, it has a $500 debit balance in job 2. So you're going to have to come up with a credit, or you're going to have to prepare a credit to get it out of there. So it's now out. Now, part of the factory will now restart this. You'll start working again because you still have to finish job number 2. But you, the accountant, are hanging around and you got this credit and you don't have a debit. And that's not considered to be a good thing in accounting. The debit is to here. Basically what happened is we found the missing debit. When spoilage happens in one of these jobs, in effect what we've done is we've found, it's like, wow, we found this thing we estimated. We estimated it over here. Now, notice that I just realized my example is a little bogus because I estimated 50 and then we have spoilage of 500. I should have lined this estimate up a little bit bigger. Let's assume that, we added a bunch of zeros. This is a big number. So what happened is we know that the spoilage is out there. We don't know where it is, but bang, when it actually occurs in that job, it's almost like, oh, we found that spoilage that we had guessed was going to be around. And so we can pull it out of job 2 and we actually do this debit. Now notice this debit is actually going to balance off against the little piece of the POR. Because inside that POR, that $0.7 per unit POR, a little tiny, tiny piece of that is this spoilage. And so this lump will balance against all those little deductions because every time the 0.7 POR was journalized, a little tiny piece of that was actually just this estimated spoilage. So when you first do this, your brain like implodes because you're thinking, are you crazy? We have spoilage and we're going to debit manufacturing overhead? That's nuts. But practice it a few times. Think about the logic I'm presenting here, especially that concept that you now have the budget. One of the problems you have in learning this is you really haven't done a lot of budgeting yet, right? But that's always a problem in accounting. Accounting is so complicated. It's so interconnected. Every piece of accounting touches every other piece of accounting. So one of the problems we have to try and teach you things is there's no place to start. We just have to pick a place and start. And every place we start has some other things associated with it that we don't have time to deal with. So to really understand how the accounting for spoilage, you have to know a fair bit about budgeting, like in your gut, in your long-term memory. So you'll notice this happens all over in financial accounting, taxes. Every place we go, we're such a complex discipline that there is actually no beginning. You just have to start somewhere and live with the flaws and mediate them. So anyway, that is the first look at accounting for spoilage. In a following recording, I'll set up a problem and we will do the meat and potatoes of the journal entries implied by this. This is our generic model. Try and learn from both of them. Having look at this, study it a little bit, and also after you've had a little time, go and look at the next recording and you'll see the sort of meat and potatoes through the journal entries. When you can go back and forth between these two, you will have started to understand the flow of the budget cycle into the forecasts. This will also help you with standard costing, because especially in Chapter 7 in standard costing, which is the creation of the standards, in effect what we're doing is, in Chapter 7, we're doing the forecast for all the input items. Actually, that's wrong. We're not doing the forecast. Like I said, in this class, we don't do the forecasting itself. The book is providing you the forecast, so you sort of assume that you have a team out there that has done all these forecasts, and then you're implementing the result of the forecast of all of these things. So we're doing that here with this subject, spoilage, and we'll do the same thing in Chapter 7, is you are implementing the result of a forecasting process. So notice things are starting to get complex, and I'll bet some of you didn't really even think I knew what accounting was after the first couple of weeks of me talking about that other stuff, but it's actually in here somewhere. So I will talk to you in the next recording where we go over some of the details. Bye-bye.